You got conditional approval. That email felt like a victory. You're moving forward. The house is practically yours. But here's what the lenders aren't saying in that approval letter. Conditional doesn't mean guaranteed. And in the final 10 days before closing, they're watching your bank account like hawks. This is Wealth Frame Research, an in-depth analysis of mortgage underwriting, conditional approvals, and the hidden financial verification protocol that catches buyers off guard. We're pulling data from public lender disclosures, HUD underwriting guidelines, and the actual approval conditions lenders attach to conditional offers. What we found reveals a critical gap between what buyers think conditional approval means and what lenders actually require. Let's start with the foundational reality. Conditional approval is not final approval. It is legally and contractually conditional. The lender is saying, we will fund this loan if you satisfy X, Y, and Z conditions. The conditions can include anything from appraisal contingencies to employment verification to proof of liquid reserves. But here's the mechanic that trips up most buyers. The conditions are verified at multiple stages, not just once at the beginning. Research shows that approximately 8–12% of mortgage files that receive conditional approval experience some form of re-underwriting, modification, or temporary suspension before final funding. That's not speculation, that's institutional data from major lender workflows. Some of those suspensions are minor, some force renegotiation, and some in extreme cases result in loan denial or withdrawal. The liquid reserves condition is particularly dangerous because it sits at the intersection of two underwriting concerns: proof of financial stability and debt-to-income ratio calculation. Let's unpack why that matters. When a lender approves you, they calculate your debt-to-income ratio, the percentage of your gross monthly income that goes toward debt payments. Current underwriting standards allow for back-end DTI ratios of 43–50% depending on credit score, asset verification, and loan program. The moment you deplete your savings to cover closing costs, two things happen simultaneously. Your liquid asset position weakens, and your DTI calculation may need recalculation because the lender can no longer verify the reserves they approved you on. Consider this scenario. A household earning $120,000 annually gets conditional approval for $385,000 loan at 6.8% interest. The current mortgage payment lands at approximately $2,570 per month. With existing auto loans, student loans, and credit card minimums, their debt-to-income ratio sits at 44% within acceptable range. The conditional approval letter requires proof of liquid reserves equal to 3 months of PD, principal, interest, taxes, and insurance. That's roughly $9,200 in verified savings. The buyer has $22,000 in their account, but closing costs on a $385,000 loan with 2.5% estimated fees will run between $7,700 and $19,250. Many buyers plan to withdraw $15,000 to $18,000 from savings to cover these costs, leaving them with $4,000 to $7,000 remaining. That's below the 3-month reserve requirement the lender specified in the approval conditions. Here's where the trap gets tighter. The lender's underwriting department conducts a final verification of deposits, a mandatory recheck of all bank statements, typically 3 to 7 days before the scheduled closing date. This isn't optional, it's a compliance requirement. The underwriter pulls fresh bank statements and they notice the balance has dropped from $22,000 to $5,000. They see a large withdrawal. They don't know if it was for closing costs, emergency expenses, or something else entirely. Protocol requires them to flag it. The file goes back to conditional status. You get a call or email. We need an explanation for the recent withdrawal, updated bank statements, and confirmation that these funds were used for approved closing costs. If you can document that the withdrawal went directly to the title company or escrow, you're likely fine, just delayed. If the timing is murky, if the withdrawal occurred before you had a purchase agreement, or if the documentation is unclear, the lender can request additional verification, demand proof of new reserves, or in rare cases, reassess your qualification entirely. But there's another layer. Some lenders, particularly those using automated underwriting systems, will flag large cash withdrawals as potential fraud indicators or evidence of undisclosed debt. Automated systems don't understand context. They see negative patterns, declining asset balance, large outflows, timing inconsistent with closing. The file triggers a secondary review by a human underwriter, and now you're in a 5–7 day hold while they manually verify everything. Data from the Federal Reserve Survey of Consumer Finances indicates that first-time homebuyers carry median liquid assets of around $23,000 at the time of purchase. For borrowers in the $385,000 to $420,000 price range, roughly the national median home price in 2024, closing costs eat 5–6% of that liquid cushion. The math is tight. One unexpected withdrawal, one timing miscalculation, and you've triggered a re-underwriting cycle days before closing. Let's talk timeline specificity because it matters. Lenders lock your interest rate at specific moments, often when you receive conditional approval, sometimes later when you formally clear conditions. But they don't lock your financial profile. Your credit report gets pulled multiple times, at pre-qualification, at application, at conditional approval, and again 1–3 days before closing. Your bank statements get verified at application and again during final underwriting. Your employment gets verified at multiple stages. Your liabilities get re-verified. Your assets get re-verified. The critical window is the final 10 days. This is when final underwriting intensifies. Underwriters are required to verify that nothing material has changed since conditional approval. Material change includes new debt accounts opened, increased credit card balances, change in employment status, significant asset reduction, or major withdrawals that fall outside the documented loan scenario. IRS Publication 590 and HUD guidelines distinguish between earned income and verified reserves. Reserves must be documented, sourced, and stable. $15,000 withdrawal from $22,000 account looks like reserves are being depleted, not deployed for closing. If the lender approved you with the assumption that you'd have reserves remaining after closing, a withdrawal changes that assumption. So what's the strategy? Documentation is everything. If you're planning to withdraw funds for closing costs, don't wait until days before closing. Coordinate with your lender and title company. Get written confirmation that the withdrawal is expected and documented. Provide a written explanation of exactly where the funds are going and why. Use a cashier's check or direct bank transfer to the escrow account. Avoid cash or personal checks, which trigger additional verification questions. Second, ask your lender to specify the exact liquid reserve requirement in writing when you receive conditional approval. Don't assume. Get the number. If they require 3 months of PD or 6 months of reserves, know that upfront. Then build your closing cost strategy around maintaining that reserve level after closing. Third, if you need to tap savings before closing, do it immediately after conditional approval, not days before. This gives time for the transactions to clear and for you to rebuild if needed. Withdrawals made 14+ days before closing are less likely to trigger re-verification flags than withdrawals made 3-5 days before closing. Fourth, understand that different loan programs have different reserve requirements. Conventional loans typically require 2-6 months of PD in verified reserves. FHA loans require 2 months minimum. VA loans have different thresholds. USDA loans have their own standards. The approval letter specifies yours. Read it carefully. Research into underwriting delays shows that reserve-related re-verifications add an average of 2-4 days to the closing timeline. If your closing is scheduled tight, especially if you're coordinating with a seller, a builder, or a new job start date, this delay can be costly or even catastrophic. Let's also address the psychology here. Lenders know that buyers are financially stressed at closing. The down payment is already gone, the inspection and appraisal fees are paid, the earnest money is held in escrow, closing costs are looming. Psychologically, buyers feel pressure to access any remaining savings. Lenders see that pressure and they see the predictable pattern. Approval triggers financial depletion. The lender's job is to manage risk. Large withdrawals near closing are a risk signal, whether justified or not. The research is clear. Buyers who maintain visibility with their lender throughout the process, who update their lender proactively about any financial changes, who coordinate withdrawals in advance, and who keep detailed documentation experience zero friction in final underwriting. Buyers who treat conditional approval as final approval and then scramble to cover closing costs in the final week face delays, additional verification requests, or worse. One final critical point. If your approval is contingent on maintaining a specific reserve level, you are legally and contractually bound to that condition. The lender can enforce it. If you violate the condition by depleting reserves below the stated threshold, the lender has grounds to renegotiate terms, demand additional collateral, or in extreme cases withdraw the approval. This is rare, but it happens. It's in the fine print of conditional approval letters. Smart buyers read their conditional approval letter like a contract because it is one. They identify every single condition. They verify the timeline for satisfying each condition. They understand which conditions are deal breakers if not met, and they coordinate their financial moves with those conditions in mind. Conditional approval is a significant step forward in the mortgage process, but it is not permission to relax your financial discipline. In fact, it's the opposite. Conditional approval is when lenders are watching closest. It's when they verify everything twice. It's when a single uncoordinated financial move can trigger a re-underwriting delay or renegotiation. Know the conditions, know the timeline, know the reserve requirement. Coordinate with your